But at the end of the day, nobody knows is the way Howard Marks has described this market. Of course, he's joining us on the phone. He is the co-chairman at Oak Tree Capital. Howard, great to have you back on the program. So many folks are trying to figure this thing out. You wrote a note earlier in the month saying, and you called it Nobody Knows. Your follow-up note was called Nobody Knows Part 2. And in the original one in March, you said, maybe start to nibble, but don't go and spend all your cash because this market could keep dropping. It indeed has. So tell me how you feel right now after an additional 20% lower from that first note.
Well, the only rational approach is to like them more when they go down in price. You know, my wife said, I explained to my wife that they like at 4,000 they say they're eager buyers at 3,500, and at 3,000 they'll say they'll buy a little at 2,000, and at 1,500 they say no, they're done. And she says, well, what are they, nuts? You got to like them more as they decline in price. And you know, you still have to do your homework. You still have to understand the company you're investing in and the security you're investing in and their ability to survive a difficult environment of 6 months or 1 year, whatever it's going to be. But all things being equal, you have to like them more the lower they go. So you know, we're buying. Now we don't operate in the stock market. We're credit investors, so most of what we buy is debt. But you know, if we find a company that we think is viable for the long run, if it's selling at a discount, we'll go in, hopefully at the senior level. And if it goes lower, we buy more. The mere fact that we buy doesn't mean we don't think it's not going lower, because that's one of the things that it's impossible to have an opinion on, especially in times of chaos.
Howard, today we saw equities stabilize a tad, but investment-grade bonds, high-yield bonds were still lower. The question I think many are wondering is, even if this virus is short-lived, and it appears from the notes you do think our pain here will be somewhat contained in a period, instead of just coming off a cliff for the economy, but if we broke things on the way down, were flips switched? Were things set off when crude dropped the way it did, or the speed of the market dropped the way it did? Even if the virus goes away tomorrow, is there still going to be blowback, specifically in your area of credit?
Well, I think that's exactly the right question to ask. And yes, look, I haven't read anything that says that the disease won't be gone by 6 months from now. Whether it's a vaccine or the warm weather or the success of social isolation, most people think it'll be gone. But still, having jammed up the economy and brought it largely to a halt, it's not going to bounce back. And it'll take a while for people to rebuild their willingness to spend, rebuild their financial ability to spend, return to the habit of socializing, taking trips on planes, staying in hotels, staying on cruise ships. You know, these things are going to come back slowly, and different of them will come back at different speeds. So I don't think that the economy bounces back. If we're talking about, you know, millions of people losing jobs, I don't think it bounces back.
Are those areas, Howard, that you're interested in taking the other side of the trade right now and buying on some of these severe dips? We're looking at credit default swaps that suggest maybe bankruptcy is in order for some of these airlines or cruise lines. Energy companies, it seems, as a given now for shale companies. Are these areas the ones that have gotten hit the most, ones that Oak Tree is interested in taking the other side on and betting for an eventual comeback?
Well, you know, certainly not indiscriminate, but on the other hand, you know, and by the way, they do say in the TV ads, don't try this at home. But,
right.
You know, one of our main businesses is investing in so-called distressed debt. We believe that we're the world's largest investor in bankruptcies. So, you know, historically we have invested in the debt of companies that are bankrupt or predicted to go bankrupt. And if you buy a creditor position in a company with long-lasting assets at a reasonable price, you can make good money. Most people don't understand how making money can square with bankruptcy, but it can, and that's what we do. So, we don't desert things because they're having tough times. It's possible to overcome the tough times with a good enough deal.
Howard, I know you don't want to give away the secret sauce or exactly what you guys are picking up. Are you able to give me an idea where you do want to express some faith in these industries? Do you think the cruise lines are going belly up? Is it a trade you have to stay away from? I mean, 60, 70% drops in some of these. Are you guys, salivating at the chops to pick up some of these deals, or are they really at risk?
Well, you know what? I don't really want to talk about individual companies or industries, but merely to say, you see, I am largely what you call a behavioral investor. I think a great deal about psychology, and in general, I would say that there are very few assets where the fundamentals can get so bad that they're not a buy at some price. Now, a buy for somebody and a buy for Oaktree. Remember, we're debt buyers, so it's possible for companies to go bankrupt, and maybe a cruise line would be an example. It's possible for them to go bankrupt, but for them to pay something on the debt. And when companies go through bankruptcy, in general, the best way to understand that is that the old owners lose the company, and the old creditors become the new owners. So certainly, if a company is bankruptcy prone, it's hard to safely buy the equity. But let me just say in answer to your question that what we look for more than anything, and what your listener should listen for more than anything is, and it's hard for the amateur to know, we want to find situations where even though the fundamentals are poor, the psychology is too negative. That's really the sum and substance of the approach.
I like this, to bring in psychology, Howard. Will it change the psychology of an investor if the companies do get bailed out, but now have certain requirements? We've heard talk about, say, an airline gets bailed out by the government or gets some assistance, that they're not allowed to do buybacks. They should be wary of shareholder-friendly activity. Would you want to be a part of a credit in a company that has restrictions on them?
Well, look, I don't think that intelligent people in the government are going to put restrictions on companies to keep them from making money. Companies can only be viable if they make money. Now, maybe the government bails them out and says, okay, but from now on we own 20%. So you have a partner. But I don't think the government's going to say to an airline, for example, you can operate. We bail you out. You can operate, but you have to be, a not-for-profit. So I think that the profitability will return, and I think these are industries that we need for the future of our country. I would caution one thing. If your listeners start to think that they're going to be smart and find an industry that's going to get bailed out and they're going to buy the stocks and make a lot of money, in my opinion, it makes the most sense that in the industries where the government bails them out, the shareholders lose their investment. The experience from the global financial crisis, in which governments bailed out companies and shareholders profited, are few and far between. So you look at the auto industry. You might say the auto industry was bailed out by the government, but it went to bankruptcy, and GM and Chrysler, their investors lost their dough. So I would think it's dangerous for the listener to think that bailout is synonymous with profitability for shareholders.
Yeah, I think it's a really good reminder as we see a lot of extreme circumstances here. Howard, I want to get your macro take. I know you only got about 5 minutes left here, but I really want to know what you think from someone who has studied cycles. You wrote a book on this. You give speeches on this. You talk to aspiring investors who look up to your ability to recognize cycles. Over the last decade, it seems that the Fed and central banks have done an okay job compressing our cycle. But now, Howard, we're walking into what is expected to be a big economic chasm, not a cliff, a chasm. And on our way there, we're building a fiscal ladder to get us to the other side. And we're like strapping on this jetpack of monetary policy. Have you thought about what the risks might be on the other side if we've overestimated the degree of the severity in the economy and its long-lasting effects? What happens if we get to the other side and we're on fire from all of this stimulus?
Well, that is a possibility. Nobody can say if it's going to happen or not, or what the probability is. Obviously, the solution you're leading me to is one of overstimulation, overheating, and inflation. So, for the last 10 or 15 years, there hasn't been much inflation. Many countries in the world have wanted inflation. Most people want to target 2%, and they haven't been able to get it going. Inflation is very mysterious. But, most people accept that overstimulation of an economy can cause it to overheat, and result in inflation. And the other thing to bear in mind is that we are likely to experience what's called a supply shock, which is a trauma to the economy from inadequate availability of products. And a supply shock has the ability to produce inflation. I was there at the beginning of the 70s, and we had the Arab oil embargo, and that was certainly one of the factors that contributed to the hyperinflation that we experienced in the 70s. U.S. inflation was running 16%, as I recall, or that something in that vicinity. So, it's a possibility. Nobody can tell you it's going to happen. It may be one of the things you think about, but of course, the frustrating part of the macro is that we can think of lots of possibilities. Many of them have low probabilities of happening. Some of the ones with low probability of happening have serious consequences, but we can't protect against all of them. And that's what makes this a challenging business.
Howard, I want to continue the conversation, but we're short on time. I know, appreciate you joining us and making time at obviously a big juncture in markets here. Looking forward to more. Thanks a lot, Howard.
Well, I hope it helps your listeners. Thank you.
Appreciate it. Thank you. Howard Marks, co-chairman at Oak Tree Capital.